On September 15, 2008, Lehman Brothers filed for the largest bankruptcy in American history. History often records this specific collapse as the singular spark for the 2008 global financial crisis. The narrative suggests that regulators made a catastrophic error by letting the bank fail, a decision that supposedly brought the world economy to its knees. But what if that narrative is backwards? Evidence suggests the crisis was already irreversible long before Lehman's collapse. Getting this history right matters. We use our understanding of past disasters to write the laws that protect us in the future. Misdiagnosing what broke the economy in 2008 leaves us exposed today. Believing that a major bank failure will always destroy the system leaves regulators with only one option: handing over trillion-dollar taxpayer bailouts the next time a megabank stumbles. To understand why the system was already failing, we have to look at the years leading up to 2008. The financial world was operating on two separate tracks: highly regulated traditional banks and an invisible network operating in the dark. This Federal Reserve chart compares traditional bank funding against the shadow banking system. The shadow banking line curves sharply upward, surpassing traditional banking. By 2007, this unregulated network reached $13 trillion, completely overtaking the traditional economy, with a $4.5 trillion gap. Low-quality subprime mortgages fueled this machine. Wall Street bundled thousands of fragile individual loans into dense financial products called CDOs. Rating agencies then applied mathematical models, giving these bundles authoritative AAA ratings, completely masking the true risk of the underlying loans from global investors. $13 trillion in hidden toxic risk had effectively hollowed out the global economy long before any single bank failed. 6 months before Lehman, another major investment bank reached the edge of collapse: Bear Stearns. Rather than allowing a bankruptcy, the government engineered a $29 billion bailout to prevent Bear Stearns from defaulting on its obligations. This intervention sent a specific signal to Wall Street. It established an expectation that the government would rescue any institution considered too large to fail. Throughout the summer of 2008, as their balance sheet bled out, Lehman Brothers leadership, helmed by CEO Richard Fuld, relied on this expectation of a rescue. Because Lehman anticipated a government bailout, they conducted no planning for a bankruptcy filing. They were completely unprepared for a failure. When the government changed course in September and let Lehman fall, the result was a frantic last-minute scramble. Billions in derivative contracts vaporized purely because the bank had no strategy for an orderly wind-down. The ensuing global panic stemmed from a reckless lack of preparation and the sudden shock of broken expectations. The Lehman myth continues to pose a systemic threat to our financial architecture today. If regulators assume that a major bankruptcy will always shatter the economy, they have no alternative but to use taxpayer money for bailouts. Title II of the Dodd-Frank Act was designed to solve this by giving regulators the authority to dismantle failing institutions without a bailout. The single point of entry strategy allows a massive institution to be partitioned. Toxic debt is isolated at the holding company level, while healthy assets are moved into a fully solvent bridge institution to keep the market stable. To prevent another frantic scramble, banks must now maintain living wills, blueprints for their own liquidation. This requirement forces institutions to plan for their own failure during peacetime. When the next crisis arrives, regulators must trust this new architecture and allow for failure rather than resorting to emergency rescues. Discarding the Lehman myth allows for orderly bankruptcies that place the cost of failure back on the financial institutions rather than the public.